It's only been a few weeks since our big lecture series video on credit scores, why they matter and how you can improve yours. But here we are with another video on the topic. The last video gave great advice and an overview of things you need to know. Most people will probably be happy with that information. But for some people, like me, it wasn't specific enough. So here come some details and a lot of numbers. I'm pretty excited. So let's start with a few facts, and then we're going to see what shows up on a credit report. There's something important to understand before we can talk about anything else in this video: how reporting works. Your credit score is only affected by items that are reported. When you pay your bills for credit accounts, car loans, mortgages, credit cards, and the like, the company you pay will then report that transaction with credit agencies. They mark the transaction with a status to indicate if things are being paid on time. No reason to get into those details here, but basically anything other than a perfect on the report indicates that the account is going to hurt your score in some way. That perfect helps your score. But the big thing here is that the company has to report this for it to show up as a new line on the credit score. When you're paying or potentially not paying for an account like a mortgage, they're likely to report every month. But if you're looking at certain kinds of problems, like an overdue cable bill, it's possible they'll report it when the bill is first owed, and then not report it again, or report it once in a while after that. There's a few reasons that this is important. First, your credit score is determined by any items on a credit report that have been reported in the last 2 years, and only by those items. That doesn't mean you don't owe them money, and most lenders are going to look past the score at the amounts you owe before offering you credit, but your credit score isn't any lower for it. Don't let this make you think that those collections won't be a big deal. Many times, companies sell the debt to another company, who will then pick up the torch and report again. Keep in mind that I said nothing after 2 years counts. That includes positive credit. If you haven't had anything on your credit report for the last 2 years because you paid everything off, your score will drop, and may even report as a no score. Even if you never had a late payment in your life, your credit score could be lower than someone with a few credit lines and a number of older collections. That is why I said in the last video that the best financial decisions aren't always the best decisions for your credit score. The 2-year rule isn't just a cliff that credit falls off, however. There's a slope that each item travels down before it falls off your score. Items within the last 30 days count the most. Then any item from 31 days to 12 months counts for a little less. Then after 12 months, the whole next 12 months counts for even less than those. That's why when you catch up on a late account, your score can jump back up. The old report that showed you as past due fell into that second range, and the new report that shows the account as current is weighed higher in the last 30 days range. We'll talk next week about a few more credit score details. There's a lot that goes into these calculations, and not a lot of public information about it, so I want to make sure that we have the chance to cover everything. As always, please leave questions in the comments or email us directly. Please like and subscribe if you haven't to keep up with our weekly updates. Thanks for watching.